Everybody, welcome to Trading Capital's exclusive analysis. In today's video, we're going to be discussing the major indices: gold, Bitcoin, natural gas, oil, and of course the interest rate market and what lies ahead in terms of this week. So today the markets had a pretty significant rally. The S&P 500, the SPY ETF, finished with a solid green candlestick here, up 1.1% on the day. Now, it wasn't a straight rally early on. There was actually some selling initially, and then it had a pretty powerful rally pretty much all day long. You can clearly see that it hit its first technical support, which is this pivot high. Not only did it hit this pivot high, it also coincided with the short-term 20-day moving average, this blue trend line moving average over here. So clearly there was some technical support after having a pretty significant 1, 2, 3, 4, 5, 6 day sell-off. Not all days were sell-offs. You had a couple green days in there, but nonetheless, it was pretty much a 6-day sell-off into technical support. Now the big question is, can the bulls really hold this level, or is this just a little bit of a short-term oversold bounce? I think it's pretty much a short-term oversold bounce. There's a couple reasons why. If you look on the intraday chart of the SPY ETF, we still have this head and shoulders pattern that is triggered. You have this left shoulder here intraday. You have your head. You actually formed a bear gap over here by gapping down and forming a right shoulder. And basically the downside of this pattern actually takes us all the way down to roughly about, on the charts, let's just see here, should take us down to about 426 and change. You can see it was this consolidation period over here before you broke out to the upside. So I still remain a little bit slightly more bearish in the near term. Not saying the markets can't trend higher. Maybe we get a retrace back to the neckline before we roll over. But I do think based off of this valid intraday head and shoulders pattern, we should see a little bit more downside in the near term. Now, on the daily chart, there's really not a head and shoulders presence, but nonetheless, you are holding technical support, and we'll just give it the benefit of the doubt as of now, considering the bulls had a pretty powerful day. Looking at the QQQ, the Q's had a significant gap up. You can see that it has a gap over here now sitting around 357.59 at the low. And basically, even with the powerful rally today, you can see it's still closed inside of this bearish breakdown bar. Now, the short-term price action of the Q's, there was a head and shoulders, left shoulder, head, right shoulder, but you've actually negated this neckline now. Now, you do have a smaller one that is technically still valid. Here you have a left shoulder, your head, your right shoulder, but this does leave a great deal of potential more upside that the Qs can retrace to. But it's interesting to see that the Qs still finished inside of that bearish Monday reversal candle, as opposed to the S&P 500 basically closed above its bearish candle. So what that's telling me is there's still a lot of tech, or still more selling that is transpiring across the tech space. And again, if technology sells off any more, it will naturally bring the indices down, being the fact that is the heaviest weighting. The Russell also had a magnificent rally today, finishing up 1.44%. So the Russell's an interesting chart here, the IWM, because we've touched base, at least I touched base with my members about this bullish consolidation that was occurring, which did favor a breakout to the upside. As long as you did not get a daily close below this key breakout trend line, this from your major all-time high, major pivot, and then you can clearly see on the daily chart you got a couple days close below this key trend line. Now, you did hit the top of this bear flag channel, which is why we got this technical bounce. But the big level for the Russell now is, can you get another daily close back above this trend line? If you can, it does favor a little bit more upside. But if we get rejected at this key trend line on a daily close, the likelihood of this pattern heading lower is much, much more likely. I still think that the Russell is likely going to test this 175.64 level, and then even the low end of this range over the coming sessions, due to the fact that simply if you look at what is happening in the interest rate market. So let's touch base on the 2-year yield first. So today we actually had a big dip in yields going all the way down to 4.65%, which is why I think the markets rallied significantly. And then the yields reversed. Yields reversed with a ferocious bounce back. I mean, you had this mega gap down, you had this bearish chop, a bigger breakdown, and then you had positive economic data that ripped the markets higher. Today you had strong consumer confidence data, and you had magnificent new home sales that absolutely soared past the consensus. Consumer confidence came in at 109.7. Consensus was 104. New home sales came in at 763,000 versus consensus 675,000. And the markets took that significantly well and rallied. Now, let's be clear. Although new home sales are ripping face and beating expectations and consumer confidence, those two key attributes of economic data directly affect inflation, which is why I believe we saw yields have a big reversal candle. Yields right now in the daily chart and weekly and monthly are in a very, very powerful uptrend. I still think that based off of this initial pullback, tagging or kissing support, bigger breakout to the upside, closing above this key resistance pivot, and now you're putting in bullish consolidation to move higher. It's very likely that this 2-year yield could eventually break out of this pattern and test the all-time highs. And let me be clear, if the 2-year yield tests this all-time highs, we're going to have a very, very aggressive and hawkish Fed. And considering the Fed is kind of still has a little bit more wiggle room, being the fact that the Fed fund is at 5.25, the 2-year yield's at 4.75, there's about a 50 basis point spread of leeway that the Fed has. That can change very, very quickly, considering how yields have a tendency to go parabolic or have a tendency to drop very quickly. This was the banking crisis over here, and it seems that market participants have greatly forgot about the banking crisis, where I still think there's going to be something that rears its ugly head. And tomorrow, we have Powell speaking at 9:30 a.m., as well as the fact we have the Fed bank stress test. So there's two big 9:30 events that transpire tomorrow, and I think that Powell is going to be forced to be aggressive based off of simply the fact that the economic data in the housing market is coming in so robust, which is a direct contributor to inflation. And what was actually interesting today is we actually did receive some Canadian inflation number, and the median CPI year over year, the May year over year period, actually increased by 0.1%. So remember, the Bank of Canada was one of the first central banks out of the G7, G20 countries that paused. And as of their last meeting, they were now one of the banks that actually continued raising rates, whereas the Fed has paused. So are we going to see a glimpse where inflation does come in a little bit hotter? Time will certainly tell, but with housing ripping face again, that's never a good sign for the Federal Reserve and their inflation fight, because it is such a big contributor to the overall gross picture of the economy. Now, what was also interesting is if you look at the long end yields, so let's pull up the 20-year yield because many people trade the TLT. TLT is the inverse of the 20-year yield. So the TLT, keep in mind, we still have this fake print. This wick all the way up to 4.3% never happened, which makes me think that the 20-year yield is actually going to get up there. Now, this 20-year yield has actually technically broken out of this wedge pattern. You can clearly see you had your rising bottom over here. You had your downsloping trend line over here. You broke out, got your retest, and now you're just consolidating above the key 50 moving average, and this is looking poised to actually scream and push higher. So yields are in a very, very strong uptrend, which means that the bond market is likely pricing in inflation remaining stickier, and perhaps which means interest rates have to stay higher for longer, which is what the Federal Reserve has been telling us all along. And to be clear, with Powell speaking tomorrow, he is likely going to jawbone this market. And that's probably going to be negative for equities tomorrow. So I'm going to be watching the interest rates very carefully. And if Powell jawbones the market, it likely means that the dollar is going to probably catch a little bit of a bid. The dollar's actually been very weak right now, but it's still holding technical support. Really, the dollar I'm watching on a weekly basis. If you look at the dollar on a weekly basis, the key moving average that I'm watching is the 100 weekly moving average, this white upsloping trend line. It is in a clear technical uptrend. You bounced over here off of it, and now it's coming up a little bit over here again. And the big question is, will we hold this technical 100-week moving average on the Dixie? I think it's certainly likely, and time will certainly tell. And what we could be forming here on the DXY, the dollar chart, could be this potential inverse. If I actually remove that trend line and draw this little bit of a basing formation here, you can see that this is potentially a little bit of a rounding formation. So the big question is, if this little bit of a rounding inverse head and shoulders formation breaks out, if this starts to form a right shoulder over here and breaks out, we could have a pretty big move on the dollar, which would take us back up to about 109 on the charts. Now we have to wait for this to clear and break the neckline, but just be cautious that if the dollar starts to form this rounding right shoulder over here and it actually breaks out above the neckline, it does show a potential move up to 109. And again, anything above 104 really hurts the emerging markets and equities. And that's why markets have been rallying, is because we've been kind of fighting this 104. You had a brief period here where the dollar was back above 104. You had a period here where it tested 104, but we really haven't had much sustained price action above the 104 period on the DXY chart, really since we had the big surge in the DXY up over here. But again, the dollar is looking poised to move higher in my opinion, especially if interest rates push higher. If interest rates push higher, it's going to definitely strengthen the dollar in the near term. And what's interesting is that even with the dollar closing down today, basically by 0.24%, what did gold do? Gold also had a pretty big reversal. So here we had, yet again, gold responding to the higher rates and not really catching a bit off of a weaker dollar, and stocks completely avoided the higher rates. So that's a little bit of a negative divergence again. My overall opinion, gold has broken this little bit of a trend here, and it likely means that gold is probably going to test this 1810 area. I think that's the next level. I do think that there's a chance that gold can actually bounce once it pierces the 1900. I think, this 1896 level will be a pretty big support. Maybe you get a bounce back up to the 50-day moving average. But nonetheless, I do think gold is going to trend lower in the coming sessions and retest this low 1800 level, and then we'll have to reassess from there. But simply, if you just draw a measured move off of this bear flag, so if you take this high to this low to the high of the wick, look where that takes you, the measured move, down to about 1829 on the charts. This little consolidation period before you broke out, as well as this little consolidation period on the charts. So the measured move, the Fibonacci measured move, does take you lower on gold, which likely means that it's a strong chance the dollar will catch a bid. All right, let's move along to natural gas and oil. So natural gas, basically natural gas is still holding this potential breakout. You got your close, you confirmed. Now you're putting in potential bullish consolidation. Natural gas is looking more poised in the short term to basically trade sideways, but very momentarily, based off of this little bit of a breakout here, I have it priced in that natural gas goes to about 355 on the chart. Based off of this rounding basing formation and this downsloping trend line breakout with confirmation on the daily, I do think natural gas catches a big bid to the upside. Full disclosure, I am long natural gas via UNG and a couple natural gas plays that I do think are very, very poised to move higher. Even if you look at some of the natural gas stocks like AR, you've seen some heavy volume accumulation down here. EQT has been the outperformer energy stock, completing its upside measured move. So I think, AR is going to be one of the natural gas stocks that plays catch up, and I think it's very momentarily for a big move in the short term. But needless to say, I think natural gas could maybe see, if you're a little bit more bearish on natural gas, let's say inventories come in a little bit higher than expected, natural gas could get a retrace back down to this 264 level, this breakout trend line, but that should be where it gets a very big technical bounce before it moves higher. Now, considering I am long, I do think that the higher scenario is more likelier than the lower price action scenario. All right, let's move along to the oil market. So WTI crude, very interesting price action. Crude has been getting absolutely slaughtered. Crude, despite the strong economic data, which suggests more robust economy, crude sold off, a big sell-off, 2.17% today. And this also happened on a lower dollar, a weak dollar today. So again, a little bit of a negative divergence where you had gold reacting weak when the dollar was weak, and you had oil reacting weak when the dollar was weak. Again, gold and oil have a very strong correlation to basically moving in the opposite direction of the US dollar. Not saying it's 100% correlated, but it does have a strong correlation. When both of those break the correlation in the short term, you just want to pay a little bit of attention. On the weekly chart, oil is putting in a bear flag over here underneath all the key weekly moving averages, and I do have a downside target of about 57 bucks on oil. That would likely be a very, very good opportunity to go long oil and potentially a lot of other energy stocks in the market. All right, let's finally touch base on Bitcoin, because Bitcoin has been ripping face ever since it hit the support. You can clearly see you had two supports. This major one was hit. It also coincided with this beautiful parallel channel, and Bitcoin just ripped absolutely higher. Now, Bitcoin did make a new nominal high, but it did not close above and make a new high. But right now, this is super constructive for Bitcoin. It was putting in a major bull flag to move higher. If you look at the counterparty where a lot of the negative headlines in the crypto market has been, it's been around Binance. Binance has not participated in this rally. Notice how the fall in BNB basically has created this bear flag. And look at the price action in Bitcoin. Boom, a bull flag. Basically the mere opposite patterns. And that is very rare, considering that Binance is the largest crypto exchange in the world, accounts for more than 10 times the trading volume than any other platform combined. There's something lurking in the crypto space. A lot of people are flooding out of the BNB coin and into Bitcoin. Bitcoin is clearly showing and displaying its dominance. But again, if there's some sort of issues with this BNB token, which based off of the technical chart, breaking this major bearish wedge, and being the fact that there's no real technical support, basically from this range of 184 all the way down to 44, there's some liquidity issues that could be coming in BNB. And again, if BNB breaks this bear flag and starts to have a parabolic fall, or a precipitous fall, I should say, that will put strain on the overall crypto industry. But BNB, there's something lurking in this BNB token. And again, you're clearly seeing the money flowing out of BNB by it forming the exact opposite pattern to the overall Bitcoin chart. But again, I've remained skeptical on this bull flag, especially when the BNB token is very, very weak. Now, based off of this pattern and the technicals, Bitcoin could actually have a move all the way up to about 33.6 before it hits the top end of this wedge and hits major resistance. But needless to say, you are fighting, and you could maybe come up and test this weekly 100 moving average. That would be a pretty big critical resistance level for Bitcoin on the weekly chart. But as of now, Bitcoin is looking constructive to move higher, but remain skeptical, being the fact that that BNB token is not participating in this crypto rally. And again, with Binance being the largest crypto exchange and their token having major issues on a technical basis, something could be brewing right around the corner that could literally cause crypto to fall very precipitously, especially if Binance is caught up in some sort of nasty fraudulent activities, or if they're sued by the SEC or whatever it may be. We just don't know until it actually hits, but the charts are not looking positive at this moment. And again, if you look at the correlation between Bitcoin and BNB, they are very correlated. So when the coin, one of the leading coins, BNB, starts diverging from Bitcoin, that is definitely a problem in my eyes. On that note, I am going to sum up this video. Definitely stay tuned for Powell tomorrow at 9:30, as well as the Federal Reserve Bank stress. Considering I haven't touched on banks, the KRE is going to be interesting. KRE right now is holding technical support, but it had this bullish flag forming, and it failed and broke down. Basically, that's not a good sign for KRE. The only positive is that you are potentially putting in maybe this little bit of an inverse head and shoulder, where you have this rounded left shoulder, you have your head, and you could potentially be forming this right shoulder on a weekly chart. But the big question is, if interest rates do break out from their uptrend and push higher, you know they're going to put a lot of additional stress on these banks. And again, the bank stress test that the Fed does tomorrow will likely could be problematic to some of the regional banks, which is what I'm going to be paying very close attention to. If you look at the XLF right now is putting in yet again another much larger, you can see on the daily, it's a daily bearish wedge forming, but on the weekly chart it is looking absolutely horrific. This weekly bear flag forming. This is a picture perfect bear flag where you have this upsloping channel underneath key moving averages. This is poised to break lower. And again, if you do a measured move from the high to the low, this takes us down to about 28 bucks on the chart. So you have to wonder what the likes of JP Morgan, Bank of America, what would happen? And again, this is enough consolidation right now to break this bear flag. Maybe the bear flag breaks tomorrow on the stress test. For all we know, there could be very, very negative news for banks on the stress test. Or maybe it's positive and a lot of the banks are actually more financially solvent. But if you look at the net interest margins of banks and where interest rates are and people fleeing from banks to more of the treasuries, it's certainly not looking likely that the banks are going to be beneficiaries from this next stress test that is set to take place tomorrow. So on that note, thank you all for watching this video. Please give a big like down below, subscribe to our YouTube channel, and if you're looking for more and additional insights, definitely subscribe and check out our Trading Capital website at tradingcapital.ca. Take care, everybody, and hopefully this video is informative, and we'll see you on the charts tomorrow.